On the 4th of November 2025, just 3 weeks prior to the autumn budget, Chancellor Rachel Reeves made a significant pre-budget speech laying the groundwork for what's coming in the autumn budget on the 26th of November 2025. Using the latest analysis and insights from this speech combined with expert insights from the Treasury briefings, public analysis from the IFS, Resolution Foundation research, and a BCG alumni event that I recently attended, I'm going to share the 10 most likely tax changes, including their likelihood rating. Now, every potential change that we discuss comes from at least 3 independent resources. Now, one of the most significant elements of the speech was that Rachel Reeves explicitly refused to rule out breaking Labour's manifesto promises on income tax, signalling that major tax rises are actually being considered and potentially on the way. The first biggest potential change is for the income tax threshold freeze to be extended up to 2030, with this one being given a likelihood rating of 98%. The personal allowance freeze will raise £44.6 billion by 2028-2029 tax year, according to OBR official calculations, with the expectation that the personal allowance will now stay frozen at £12,570 instead of rising with inflation until at least 2030. The shocking thing here is that since April 2021, this threshold hasn't moved at all. If it rose with inflation, it would be approximately £16,385 by the 2027-2028 tax year. This matters substantially because tax as a share of national income is forecast to hit 37.7% by 2027-2028, the highest in a generation. The cumulative effect of this freeze since 2021 means that taxpayers are already contributing significantly more in real terms. Basic rate taxpayers earning between £40,000 and £45,000 will see an additional £500 to £800 per year initially in tax, rising to £2,000 plus by 2027-2028, as they're pushed into higher tax brackets, faster than under normal inflation indexation. At number 2, we have the possible introduction of employer national insurance on limited liability partnerships, with this one being given a likelihood rating of 95%, as it's been strongly signalled by the government already. Extending the 15% employer national insurance to LLP members would raise approximately £2 billion and could pose a personal hit of over £9,000 to £15,000 per year for affected professionals. This includes lawyers, accountants, consultants, and GPs throughout the UK. Currently, these professionals only pay 6% Class 4 NI on profits between £12,500 and £50,270. An LLP partner earning £100,000 can therefore save around £9,000 to £15,000 annually compared to an employee earning the same income. This structural advantage has been a key incentive for professional partnership structures for decades. This change is expected to affect approximately over 300,000 professionals. Many will restructure into limited companies, triggering additional accounting and legal costs to help maintain their tax efficiency. Please do note though that the £2 billion figure does actually come from tax policy analysis rather than official government forecast. Actual revenue may vary based on how many professionals restructure. At number 3, we have the potential for capital gains tax rate increases for business owners, with this one being given a likelihood rating of 99% as it's already legislated. Business asset disposable relief automatically increased from 10% to 14% in April 2025. It will then increase up to 18% in April 2026. Costing entrepreneurs over £40,000 on £1 million sales. These changes are already happening. However, some think tanks have now suggested that a potential 24% rate could be introduced in the budget, but this does still, however, remain unconfirmed. These rate increases fundamentally alter the calculus for business founders considering exit timing. At number 4, we have possible pension tax relief cuts, in particular salary sacrifice reforms. This one has been given an 88% likelihood rating, coming from think tank analysis rather than being confirmed by the Treasury. Pension relief cuts could raise between £5 and £10 billion and could cost high earners on average £500 to over £1,500 per year. The proposal under consideration caps annual pension relief at £2,000 instead of current allowances, fundamentally changing retirement planning for high earners. Pension tax relief costs the government around £52.5 billion annually, according to HMRC 2023-2024 data, larger than the entire defence budget. This is a massive target that Reeves has clearly signalled will be scrutinised as part of the broader spending reduction needed for the government to meet fiscal targets. The Treasury is believed to see this as a crucial area for raising revenue going forward. Please note that revenue figures are based on think tank analysis and not official forecast. Actual yield will depend on the final design of the relief restrictions. At 5, we have the potential for council tax bands G and H being doubled. This one has been given a likelihood rating of 90% and comes from Treasury leak analysis. Doubling council tax bands for G and H properties would raise approximately £4 billion. Band G properties, those ranging between a valuation of £750,000 and £1.5 million, currently pay around £3,500 to £4,500 annually. Under this proposal, this would be £7,000 or £9,000. It's also expected that Band H properties, those worth over £1.5 million, would double in a similar way. This represents the most significant council tax overhaul in decades. The IFS calculates that 75% of revenue comes from Band G properties. This includes ordinary London homeowners with appreciated property values, not just oligarchs. A retiree on a fixed income could face over £8,000 in council tax fees and might be forced to downsize, impacting property values and creating potential market distortion. This would particularly affect South East pensioners who purchased pre-2000 properties and benefited from property inflation. Please note that this does remain a proposal based on leaked reporting and it's not confirmed policy yet. The implementation date and phasing does remain unknown. At number 6, we have the possible introduction of Landlord national insurance on rental income. This one has been given a 68% likelihood rating, classed as a Treasury leak but not yet officially confirmed. Adding 8% national insurance to rental income could raise £2.3 billion. A landlord with £25,000 annual profit currently pays £5,000 in income tax. Under this proposal, they would pay £7,000 total. £5,000 income tax plus £2,000 in NI, raising the effective tax rate from 20 to 28%. Now, it is considered that the landlords would pass these costs on to their tenant. A £1,000 rent would likely rise to £1,050 to £1,100 within 6 months of implementation. For struggling renters already dealing with cost of living pressures, this remains a serious concern. Multiple housing charities have warned that this would particularly impact lower income private renters in high demand areas. Now, I do have an important caveat here. The design and release available do still remain unknown, and this proposal has not yet been confirmed by the Treasury, although it has come from a Treasury leak. We still have no details existing on the phase and timeline or the potential small landlord exemptions. At number 7, we have the potential introduction of mansion tax on homes over £2 million, with this one being given a likelihood rating of 72%, coming from think tank analysis but not yet confirmed by the Treasury. A 1% levy on homes over £2 million could raise between £1 and £2 billion and would hit over 300,000 properties in England and Wales, with £10,000 to £30,000 per year per mansion. Similar mansion taxes do exist in France and other European nations, serving as a potential policy template for the government. If London property appreciates at 2 or 3% annually, but you pay 1% mansion tax, real returns drop to 2 or 1%. The market would experience pressure, with international investors likely pausing purchases. Property values at thresholds could face compression as buyers avoid tipping into the higher tax band. Please do note here that this does remain in proposal phase with no official confirmation. Alternative levels, including £1.5 or £2.5 million, have also been discussed but are also not confirmed. At number 8, we have the possible implementation of inheritance tax. This one has been given a likelihood rating of 62%, again coming from think tank analysis, however not yet confirmed by the Treasury. The proposal is that we might see lifetime gift caps at approximately £100,000, with ranges currently being discussed of £50,000 to £200,000. This could raise between £1 and £2 billion, but remains highly speculative. Gifts above the cap would be clawed back at death and taxed at a 40% inheritance tax rate. This would close significant tax planning loopholes used by wealth managers across the UK. In this situation, if parents gift £300,000 across their lifetime, but under a £100,000 cap, £200,000 might be clawed back, resulting in an additional £80,000 IHT bill. This represents a fundamental restructuring of how families can transfer wealth, affecting millions of estate plans currently in place. This does still have implementation uncertainty though. Precise mechanics remain entirely unspecified, and questions around annual gifts, spousal exemptions and charitable donations still remain unresolved. This is firmly speculative until Treasury details emerge. At number 9, we have potential changes to when companies have to register for VAT. This one has been given a likelihood rating of 60%. VAT threshold changes remain highly speculative with no confirmed direction from the Treasury just yet. Current VAT threshold registration is at £90,000 and this remains changed since April 2024. Think tanks are a bit undecided on this and some are discussing that this could be classed as pro-growth if it's seen as being raised, or if it's being lowered, this would be classed as revenue rating. However, Rachel Reeves has remained notably cautious on VAT increases throughout the pre-budget statements. The current view is that the Treasury is unlikely to lower the threshold, but they may raise it up to £100,000 or higher as a pro-growth signal. A lower threshold would be devastating for many businesses, whilst raising it would actually support the startup ecosystem and support small business growth. At number 10, we have possible capital gains tax on primary residences over £1.5 million, with this one being given a likelihood rating of 75%, with this one coming from Minister non-denial. However, it's not yet been confirmed by the Treasury. In August 2025, Treasury Minister Torsten Bell was asked directly around ending the private residential relief on high-value homes. He deliberately declined to rule it out, saying that these are matters for the Chancellor. A strong signal, but not confirmed policy. This careful non-denial from a senior Treasury figure does suggest that active considerations are underway. This would end the CGT exemption on homes over 1.5 million. Homeowners would pay 18% CGT at basic rate or 24% on the high rate gains above this threshold. This would affect approximately 120,000 high rate taxpayers with an average CGT bill of over £200,000 per sale, fundamentally altering the property investment dynamics. A couple selling a £1.8 million home with a £300,000 gain would owe around £72,000 in tax. And pensioners downsizing could face over £120,000 in bills, potentially forcing them to stay in oversized family homes for longer. Properties over £1.5 million represent most London South East sales, but less than 0.5% outside these regions, making this a southeast wealth tax in disguise. This does need to be taken with a pinch of salt right now though. The Minister's non-denial does signal consideration, but not confirmation. Official Treasury guidance does still confirm that private residential relief applies to all properties regardless of value. However, we don't know how long for. If you found this video helpful, you may like this video here, talking about how much you should have in your pension by age, and also why £120,000 is considered the worst salary in the UK.